Understanding mortgage product types is crucial for making informed decisions about your mortgage. So in today's video, I'll be breaking down the different types of mortgage products so that you've got the knowledge to navigate mortgage conversations with confidence. So to find out more, stay tuned. Now, before we get into the detail of today's video, guys, if you've been finding our videos helpful, then we need your support. Consider using DM Mortgages to help you to arrange your next mortgage or remortgage. And to do that, you can head over to our website and book a video appointment online. Our website is dm.mortgage, and there you can book in with one of our expert team to help to guide you through your options. I also want you to give this video a thumbs up and subscribe to the channel if you haven't already, and you want to keep updated with the latest property and mortgage news. Now, the first type of mortgage I'm going to be explaining is probably the most common type of mortgage. Well, it is the most common type of mortgage product, and that is a fixed rate mortgage. Now, a fixed rate mortgage essentially is going to give you stability of a fixed rate of interest until an agreed date in the future. So you're probably familiar with a 2-year fixed rate or a 3-year fixed rate or a 5-year fixed rate. So this means that the interest rate is going to stay the same for that period of time, okay? As opposed to other types of mortgages, such as variable rates, which means that the interest rate may vary. So with a fixed rate mortgage, you've got certainty that your payments will stay fixed for however long you initially agree to, whether that be 2, 3, or 5 years. Now, fixed rates can be great because they allow you to budget. You know exactly what you're paying. But the downside of fixed rates is that generally they're a lot less flexible than most variable options, for example. And with a fixed rate mortgage, it's very difficult if you want to repay that loan early, say switch to a new lender, you may have to pay a penalty charge to the lender. Not to mention, fixed rates are great if interest rates are going up, but what happens if fixed rates go down and you're tied in for the next 5 years, let's say? Again, it might be very difficult for you to opt out of that fixed rate deal that you initially entered into. So fixed rates are really great in one way. You know exactly what you're paying, but there are limitations to fixed rate mortgages. So it's really just about weighing up your own situation to work out what's best for you. And of course, our team can help you to do that. Now, the next type of mortgage that I'm explaining is a tracker mortgage. So a tracker is not fixed, like I just explained. Your payments can vary. So it's a variable mortgage, okay? But essentially a tracker rate, the interest rate is set at a percentage that's usually a little bit above the Bank of England base rate. So the interest rate that you pay will usually rise and fall in line with changes to the Bank of England base rate. So let's look at an example. A tracker rate mortgage could be 1% above base. So the base rate at the moment being 5.25%. If you entered into a tracker rate mortgage that was 1% above base rate, that would mean that you're paying 6.25%. If the interest rate then increased, or the base rate, shall I say, increased to 5.5%, that would mean that your interest rate increases to 6.5%. So tracker rates, again, they can vary, which is a little bit risky for some people. But for others, they prefer the flexibility of a tracker rate, and they like the fact that if rates do go down, then they'll benefit from that. So again, there are pros and cons to a tracker rate mortgage. It's about weighing up what's right for you. Now, the next type of mortgage that I want to look at is something called an offset mortgage. I'd say that this is less common and popular than trackers and fixed rate mortgages, but it is still a really great option for some people. Now, an offset mortgage gives you the opportunity to use your savings to offset against your mortgage. So essentially, this reduces the cost of your mortgage, which means that instead of earning interest on your savings, you can reduce the amount of interest that you pay on your mortgage. And this can help you to reduce the length of time it takes you to repay your mortgage, or you can choose to lower your monthly payments now or in the future, while still giving yourself access to your savings. So an offset mortgage is a really great thing to consider if you do have a lump sum of savings and you're not quite sure how to best utilise them. And offset mortgages can also be popular for higher rate taxpayers because obviously higher rate taxpayers can attract additional tax charges with their savings. Whereas with an offset mortgage, you're saving interest on your mortgage as opposed to earning on your savings. So it can be beneficial for higher rate taxpayers as well. But again, individual circumstances, speak to our team to find out what is right for you on an individual basis. As a viewer of this channel, I assume that you're considering purchasing a property in the near future. So it's important for you to know that DM Mortgages are an award-winning team of fully qualified mortgage brokers that provide advice to clients all over the UK. Now, we spend countless hours making free content for YouTube and other social media platforms to help to give you guys sound and useful information to make sure that you're in the best position to make informed decisions. To support this channel, when the time comes for you to consider your mortgage options, we want you to book a free online mortgage appointment with a member of our fully qualified mortgage advice team. Because without your help and support, keeping this channel going simply isn't possible. Now, we search thousands of mortgage products from high street and specialist lenders to find the right deal for your circumstances. And we also provide a free will writing service to every DM client. So head over to dm.mortgage and book in for a free mortgage appointment when the time comes. And also make sure that you subscribe to this channel if you find the content useful. But for now, let's get back to the video. Now, next I want to talk about SVR, which is standard variable rate. That's what SVR stands for. Now, when you're in a fixed rate deal or some variable deals as well, let's say that you're in that particular product for 2 years, then at the end of that deal period, you'll often find yourselves going on to what's called the standard variable rate. And essentially what this is the default interest rate that's set by the lender, and it serves as a baseline for mortgage payments. Now, when you tie into a product, let's say for this example, it's a 2-year fixed rate. That 2-year period might offer an attractive rate. Now, the standard variable rate tends to be a lot higher, which can potentially lead to increased monthly payments. So it's usually a good idea to start looking around at your options, not when you get to the end of your introductory period on your product, but usually we say 4 to 6 months before your product ends, start looking around at that point, because if you go into the standard variable rate, it's often a lot higher. Now, the next type of mortgage product that I want to talk about is what's called a discounted standard variable rate. So a discounted standard variable rate is, again, a type of variable rate that follows the standard variable rate. So standard variable rate, do you remember I said is set by the lender? When it's a discount standard variable rate, it means that the standard variable rate is discounted for a specific period of time. Usually that could be 2 years. Now, let's look at a working example because a discount standard variable rate can take a little bit of getting your head around, guys. So let's say that I'm going into a standard variable rate product and the interest rate being offered is 5%, okay? And that lender is applying that discount for, say, 2 years, and the discount is 3%. So what that would mean is that the standard variable rate, and remember the standard variable rate is something that a lender sets and it can vary. The standard variable rate in that example would be 8% because the lender's giving me a 3% discount. So 8 minus 3 is 5%. So I'll be paying 5% for the next 2 years. However, that 5% can change because if the standard variable rate goes up, then my payments will change in line with that minus 3%. Okay, so it takes a bit of getting your head around. Rewind that point and listen to it another time if you need to, but that is the principle of how a discount standard variable rate works. Now, it's worth me mentioning, guys, that a standard variable rate is independent from the Bank of England base rate. It doesn't mirror the base rate. So if the base rate changes, a standard variable rate may not change at all, okay? And it can increase or decrease at any time, and it's down to the bank if they do choose to increase it or decrease it. And of course, that may affect the interest rate of your mortgage if you are on a standard variable rate or a discount standard variable rate, okay? But it's worth me just pointing out again and emphasising that any changes to a standard variable rate is not necessarily linked to any change in the Bank of England base rate. And it's an important point to mention because people don't often realise that, okay? So with, I suppose, a tracker rate mortgage, which does directly track the Bank of England in base rate in most cases, there's a bit more transparency over when your payments can change. Whereas with the standard variable rate or a discount standard variable rate, that can change as and when the bank says so. So there's a little bit less, transparency or understanding, I guess, that comes with that. So in summary, guys, the complexities of mortgage types is important for home buyers, and making sure that you understand your options can really help you to make informed decisions. And of course, with the help of our expert team. So make sure that you do head over to our website and book in there for a mortgage appointment. The website's dm.mortgage, and there our fully qualified mortgage team can help you to guide you through your options, because there are loads and pros and cons that come with different types of mortgage products. And us being experts in the field, we can obviously make sure that you're getting the appropriate advice for your situation. Make sure that you like this video if you enjoyed it, and make sure that you subscribe to the channel so that you don't miss any future content uploads from us here at DM Mortgages. And I'll look forward to seeing you in the next video.